Hey everybody, this is the ESOP guy. We are on a journey to an ESOP and excited to be in season 4 and continue to look at things that I think are helpful to you who are thinking about possibly doing an ESOP. And so if this is a new episode for you or you're brand new to the podcast and you have an interest in learning more, please go to our website at journeytoanesop.com and you can find out from really a lot of different episodes that we've kind of covered a lot of different ground. Today, we're going to want to dig deeper into the question of ESOP insurance in general. And that's not my expertise at all. And in fact, I get it, but I don't get it. It's something that is important. So in order to make sure we have the right information for you, we've invited the right expert, and that is Patrick Dixon with Murray Insurance. And Patrick's going to really help us today to kind of go through what it's all about. What is insurance all about? When do we need to be thinking about insurance? And so we'll cover that in the podcast. So hopefully that will be helpful to you. And as you start continuing on your journey and thinking through, would an ESOP work for you? So as we start that, I wanted to kind of introduce Patrick. Patrick, before I let you tell everybody about who you are, tell us what your favorite movie of all time is and why. And I didn't tell you this before, so I'm kind of surprised.
I would have to have a long think on that. And straight out the gate, I really don't have an answer for you on that. I haven't really given it too much thought. So that's kind of an ambiguous start. So I really don't have an answer for you.
Let's do this. Okay, so in the category of action movies, in your English, I'll throw out to you. What about Braveheart?
They stick it to the English there. So
they totally do. That's why I was asking.
Originally from sort of the northwest of England, which is very close to Hadrian's Wall and the Scottish border there. So definitely have some Scottish heritage. So, cool. It's definitely a good movie for sure. But in terms of action movies, Rocky's got to be up there, hasn't it? Being close to Philly as well. Yeah.
I just literally watched Rocky 3 last night because my daughter and I love watching all the Rocky movies, and we're so weird. We just go back through them all. So but yeah, Rocky. I mean, so what that does, it tells everybody kind of about you, who you are, what you like, so that kind of thing. So I had to throw out the Braveheart thing because I wasn't sure if you were Scottish or English. So sorry about all that.
The red hair might indicate that, Scottish.
Exactly. That's cool.
Definitely a good movie.
Cool. So how did you get into, I know you're an insurance expert, but how did you get into the ESOP world? How long you've been part of the ESOP community?
So really, I got involved in insurance when I was in England. I worked for a Lloyd's broker doing errors and emissions insurance for architects and engineers and miscellaneous E&O. And my wife, who's originally from this area, kind of wanted to move back. She got a bit homesick. So I agreed to move over here. And my father-in-law actually co-owned a business, ski and bike shop, with a guy who actually owned Securus, and Murray acquired Securus. So we kind of had a nice lead-in for me to come to Murray here. And then they had in mind for me when I first started to help Jeff Gelbert on the ESOP program. And slowly over the last 7 years, taken on as program manager now and had a great mentor along the way. So kind of as soon as I joined Murray, really, and you join a company that's an ESOP and you're like, what's an ESOP? So I kind of had the learning experience from both being in an ESOP, but then also from being part of an insurance program, which is catered towards directors and officers, fiduciary liability, employment practices liability, for employee-owned companies. So it's definitely been a great journey and having some great mentors along the way.
Mm-hmm. Yeah, so for some people, you might know the name Jeff Gelbert because we did a podcast with Jeff, and Patrick and I were talking about it. It might have been like 18 months ago. And so there's obviously a lot of changes that have happened. The Murray Insurance, they've been involved with ESOPs for just such a long time. And I think Jeff was kind of one of the original
founders. I think the program started in 1989, I think back then it was with maybe Sedgwick, and then it moved to Marsh. And for the last 15 years or so, it's been with Murray Insurance, and now we're part of Assured Partners broker network. It's been Great American's been a program insurer now for 25 years. So definitely some great heritage, and the program's endorsed by the ESOP Association as well. And Great American's the exclusive insurer with the ESOP Association. So definitely some great partners to work on this with.
Yep. Excellent. The reason Patrick's on today is just because I'll just put a plug in for you right now. We get into an ESOP transaction and I'm dealing with a client who's like talking to their insurance people about the particular insurance that we need, which we're going to get into. But we're right before closing, and usually we're kind of scrambling to get the binder for the insurance that's going to be needed. And Patrick's name comes up all the time. And so I'm like, you got to get on the podcast, because realistically, experientially, I mean, he's coming to save the day so many different times. And it's, so he definitely is very good at it. And I think the main issue that I see with ESOP insurance is that not because the insurance people that people work with don't know what they're doing. It's just very nuanced, and it's not super straightforward in terms of not just the process, but the actual, what is it that we're going to get into? Like, what insurance do you need when you do an ESOP company? So anyway, that's your plug, Patrick, but maybe there'll be more as we go, but he really is phenomenal, and he's super, super responsive. So all the things you would ever really want. So let's talk about the different insurance in, the ESOP world. So there is fiduciary, there is D&O, and then there's the EPL. So I guess the fiduciary is the most common, from a transaction standpoint. I'm always negotiating that there's going to be a fiduciary insurance policy. Every ESOP transaction, the trustee is going to require a fiduciary policy. So tell us, what is a fiduciary policy, and who does it benefit? How does it really work? And why is it really there?
So the fiduciary policy really is covering anybody internally who might be a fiduciary, and it may even extend to an external fiduciary trustee. So it really is covering any breach of ERISA, and that might be something as severe as, adequate consideration wasn't reached on the ESOP transaction. There was an overpayment. It would cover the internal fiduciaries and potentially the external trustee in those situations. Or it may be just something as simple as a voluntary compliance issue with maybe not administering the plan properly, and maybe needing to make a participant whole in a plan. It might be denial of benefit for a welfare plan, for example. So it runs the gamut really of welfare plans, benefit plans within a company, but it just so happens that it's really important for an ESOP company to maintain that coverage.
Yeah, I mean, it's usually required by the trustee in the transaction, because they're not wanting to have an exposure where there's more of a potential for I guess an investigation from the Department of Labor, which doesn't mean that you initially have an issue or a problem or a real problem. It's just there's a potential likelihood that there might be in structuring a transaction. So the trustee wants to make sure it's there in place. And a lot of the deals that we're putting together, usually when we look at the requirement, it's usually around $1 million of coverage. What do you see? Is that kind of the normal fiduciary insurance coverage?
Really depends on the size of the transaction. The larger the transaction you do, the more coverage that will be required. So I was having to think about this, and generally we see things from maybe 2.5% of the transaction size to 5% of the transaction size in terms of the limits being required. So I'd say probably around about the 5% of the transaction size we're sort of seeing in terms of the fiduciary limits being required. As a rough. Yeah, and then we recently conducted a benchmarking of liability study across all of the ESOP companies in our program here. And of course, there might be some transactional ESOPs in there. There might be some larger ESOPs in there, which are ongoing ESOPs as well. So we also have that information we can share if anybody's interested after the podcast and reaches out to you, Philip, and we can share that information.
Yeah, if you've got anything like specific like that, we can always put it on our website. And then even if you want to put a link to your guys' stuff, I'm fine with that too. But we're just trying to the whole point of this is to be a resource. Like people need to know this information so that they can not be surprised by, hey, this is going to happen. Like you're going to have this is a cost we're going to build into the feasibility, by the way. We're going to build this into the cost of being an ongoing ESOP company. So it's just it's part of what you should be planning for.
Absolutely.
So typically the fiduciary insurance, the trustee is covered in that. Is that usually what you're seeing?
So it depends on there's this natural person wording on every fiduciary policy, and that extends to an individual trustee, but it might not necessarily extend to an institutional trustee, such as a bank.
Okay.
Now, we may be able to name an individual on the policy within the institutional trustee to have them listed, but the insurers are very reluctant to name an entity which is an institutional trustee. But an individual trustee, coverage is granted under that natural person wording sometimes. Okay. So that's something to be cognizant of when you're placing coverage, is really, asking the insurance company. They may not be aware that that natural person wording extends to an external trustee. So it's worthwhile clarifying during the process.
Yeah, for sure. And that is a decision tree that you'll go through. Do you use an institutional trustee in the very beginning, or do you use an individual trustee? And that'll be partly up to you, but somewhat guided by your advisor as you go through the process. Yeah. So in the normal requirement, so you've got a fiduciary, then where do you, D&O is kind of the next level, I guess, of insurance, and that is going to be specifically for the board of directors. Is that kind of correct? Or how would you describe the D&O policy as an additional piece of insurance?
That's right. The D&O really covers the corporate obligations of the company versus the fiduciary obligation of the trustees and fiduciaries. But one of those individuals might wear both hats, for example. So you'll find that that board member will also have fiduciary responsibilities for the ESOP as well. So really, you need to have both those coverages in place to have the full coverage. And there are also aspects of the ESOP which could potentially be covered under a D&O policy as well. For example, anything prior to the formation of the ESOP plan actually being formed, any representations or errors in the information provided in the feasibility sort of side of things. So really, to avoid any grey areas, it's best to have both those coverages in place for an ESOP. But more generally speaking, for a D&O policy, it's balance sheet protection. For an example, a claim comes in from a vendor, supplier, a regulatory body, and the entity has to indemnify itself and then pay any settlement, any judgment. That then would reduce the corporate value of the company, of the entity, which impacts the benefit plan with the ESOP. So I think it's kind of heightened to have a D&O policy when you are actually an ESOP, simply because of that balance sheet protection and the impact on the benefit plan as well. So
so just to kind of clarify that too, I think it's a really good point. The way it will affect the benefit plan in an ESOP is if your balance sheet is going to be dinged for potential claims, the valuation itself will suffer. And if the valuation suffers, because it's going to be part of you're basically going to get the total equity value will go down, because you're going to be, the company without D&O has to support the claim, and that's going to come right out of cash. So that would reduce the equity value. So that's prudent, and it's kind of normal, right? For most transactions, like it's kind of normal to get both the fiduciary and the D&O. Is that what you're seeing?
Absolutely, and furthermore, it's best to have it with the same insurance carrier, because you don't want there to be any grey areas or ambiguity over, what's more of a corporate action versus fiduciary action, and you don't want any squabbling between insurance companies on who picks up what part of the claim. So ideally, it's best to have them with the same insurance carrier.
Mm-hmm. And it's common to have an existing D&O policy coming into the transaction with another carrier. And so the best recommendation is to just go ahead and let that one go away and then replace it with a new policy with the same carrier that's doing the fiduciary. Probably cost effective and better.
And that's what we run into. Sometimes a company already has a D&O and fiduciary policy in place. So do you then put that policy for the company prior to the ESOP transaction into a runoff, into a tail to cover the exposure? or more, that's maybe cost prohibitive, or can you find an insurance carrier willing to pick up that retroactive exposure of the company prior to the ESOP transaction, and then on an ongoing basis, it might be more cost effective to have a policy which covers fully retroactively, and then on a go forward basis, making sure you cover the transaction. And again, you're not having any arguments over who's covering the transaction, the old insurer or the new insurer. The new insurer is basically picking up that exposure.
Mm-hmm. And you kind of want to time this at the, and correct me if I'm wrong on this, time it at the time that the closing is done. So the very beginning, the very next day, then you're bound and you have insurance for both D&O and fiduciary. Is that the best way to do it, or is there a better way?
Yep, you do it the day of the transaction, and we usually need to provide proof of the coverage ahead of the transaction being done, and then we let the insurer know obviously the transaction's gone ahead. So that's usually how the course runs with that.
Yep. All right. So then there's the EPL insurance. So kind of explain that part as well.
So the employment practices really covers, any sort of workplace harassment, any discrimination, any wrongful retaliation. And it really doesn't have too much specificity to an ESOP company other than it's applicable to all companies in general to carry this, because it's really a high frequency, low severity kind of coverage. And by that, I mean, you're going to see lots of claims, but those claims are going to be low dollar value claims, lots in the sort of $20,000 or $30,000 range. But if there was something specific to ESOPs on the EPL policy, it would be the retaliation aspect of ERISA, because there's an ERISA exclusion on the EPL policy, employment practices policy, but there's a carve back on that policy if for some reason a participant believed they were denied benefit and they then highlighted this problem and they were then fired. There's a retaliation carve back within the EPL portion for ERISA.
So if they were fired and they had ESOP shares and they came back and were suing the company for whatever they're claiming, right? The EPL would kick. Okay.
Yeah, so it might be something like I don't believe I received the correct dollar value for my share for the shares. So it could be something along those lines, or say for example, it was something to do with a welfare plan. I don't believe I was given the correct coverage that I needed. They highlight this to their employer, and then for some reason they're fired. There could be a carve back for the retaliation aspect of that.
Okay, got it. So primarily just for the employees. Is there any other insurance that a company might have that would protect them already from that type of issue? Because like you said, it doesn't necessarily have to be an ESOP for them to come back and sue the company.
Yeah, it would just be employment practices is more generally sort of speaking applicable for any company out there.
Yeah. Does it become, when you do an ESOP, does it increase the premium on that type of insurance because now they have a benefit there, or is it about the same?
I don't think what drives on the coverages we provide, an ESOP really drives the fiduciary coverage and the D&O premium. It doesn't impact the EPL coverage, to my knowledge anyway, because the rating factor for the three different coverages would be, on a D&O, it would be corporate assets is the main rating factor an underwriter would use to derive the premium. So we'd be looking at the size of the corporation and the financial performance. On the employment practices, it's more the location you're in. So California is a highly litigious state. You also have like Illinois, for example, lots of biometric violation claims. So it's the location and the employee count and the class of business that really drive the employment practices premium. There are certain industries which have high dollar claim values, particularly for lawyers. Those are high dollar claims. So, and then on the fiduciary front, it really is benefit plan assets that drive the premium there.
Okay, that's very helpful. So sorry, California and Illinois, and sorry for those industries like attorney firms that it is what it is. But I think it's helpful though, because there's people probably in those states that are thinking, oh no, I have more taxes and I also have more insurance, cost of doing business. So that brings me to like the real kind of question I love to talk about or think about is like, what's happening behind the curtain in your underwriting process. It's like you get a call from me or an email like, hey, we got a closing, and and then you're shooting out your things that you need. You have an application and you have certain things that you're going to need from the trustee and all that. So walk us through, like, obviously what you're going to need to get somebody underwritten, what they would provide. And then secondly, like what are they actually doing with this information from an underwriting perspective?
Yeah. So really, from the outset, to get an underwriter's attention, it's vital to have a full submission. If you send a partial submission in, especially like forming an ESOP or a transactional ESOP, if you just send, a few pieces of financial information, you're really not going to get the underwriter's attention. So, like we always say, if you want the underwriter's attention, provide a full submission, and that would include a main application, which would be like just general information on the company. It would be the D&O section, EPL section, and fiduciary section to be completed. Then, to get more specific, there would be an ESOP supplemental questionnaire, which would say date the ESOP was formed, attorney used in a transaction, valuation firm included. They really want to credential who all the professional service providers are in any transaction, and they're really looking at that ahead of the transaction. It will ask, information about the potential size of the transaction, the leverage needed on the transaction. And then you get into things like the sort of the corporate financials, pre-transaction. Then maybe you get some pro forma financials after the transaction's been completed. They really want to know how the company's performing financially. Is that going to be an ESOP which has longevity? Is it going to be able to support a share value which doesn't fluctuate too much? So really, they're looking at industries and stable performing companies if they're going to offer coverage. And then they like to see draft term sheets as well, so they can get a grapple any potential sort of name changes in a transaction, any idea on the warrants that might happen in a transaction moving forward. So they're really trying to get a grasp of the whole transaction here, and the company before the transaction, the company post transaction. Are the assigned shareholders going to be still with the company? Are there going to be new people brought in to manage the company after the transaction? So they're looking at the succession aspect of it as well. So there's a multitude of factors they're really kind of weighing up as they look to provide coverage, and the information that's provided really helps them get there quickly. And then the next big factor is NDAs and non-reliance letters, which are kind of, I think, the bane of the ESOP industry's life. Really, it's what those require is that the underwriters don't rely on the valuation report to provide coverage, essentially, in a document, and those need to be squared away well ahead of time prior to the transaction to make sure there's no hiccups with the letters in getting them go by the underwriter's legal team, for example. So the sooner you can start the NDA non-reliance process, the better. And Philip, you might be able to elaborate a little bit more on that side of things.
Yeah, I think it's having, I think the biggest thing that I would elaborate on is the, like you had said, you want all the detailed information. And so some people that I give that information to, they're really kind of scrambling and they really don't know and what exactly. So we end up kind of getting into it with them and say, all right, let's help you kind of fill out all these forms. And so on some of the other stuff, like the NDAs and the non-reliance, it's just helping kind of walk them by the hand through the whole process so that they can get that. The key is timing. You want to make sure that you have enough time to do it all so that you're not stressing everybody out in the process. Yeah. On the everything you described on the underwriting makes sense because you're just trying to figure out what the risk profile is, what you're actually insuring, what the risk profile is. On the valuation, one of the things you guys require is that you're going to get from the trustee the actual valuation that they used to negotiate the trend. So I think we give you the final term sheet, right, as part of the doc package.
Yeah, so usually to get coverage bound, they just want to see that the fairness and opinion and the valuation kind of match up the values, that there's no drastic change prior to how they were going to underwrite it and then to what actually transpired. Essentially, that's what they're trying to do with that. And they look at the various different valuation techniques as well when they look at the valuation report.
Mhm. And what's interesting about that is that the sell side can't see the valuation because it's part of a prohibitive, or the Department of Labor process agreement. The sell side can't see it ever in that negotiation and after the negotiation. So the trustee won't share it with the sell side, but with the NDA and the underwriter, they will release that to the underwriter of the insurance company, the carrier.
And the less parties that get to see that, the better, right? So
you don't even get to see it, right, Patrick? You're not going to get that.
No, that's right. The course of least resistance is best with that. It goes directly from the trustee, valuation firm to trustee to the underwriter. Obviously, you need to get the interest of the underwriter ahead of sending in that report. So once you've kind of whittled down the underwriters interested in writing coverage, that's when you really provide the information.
Yeah. So on a normal, like a timing standpoint, and then this is probably my experience. I mean, I guess would be better for you guys to have more time, but I think I usually have, like, I've seen you guys turn things around in a week. Is that pretty quick, or obviously it would be nice to have a little more time? How fast can you turn around a policy or binder?
If the information is available pretty quickly, within a couple of days. If you're approaching those insurance markets that are well versed in signing these non-reliance and NDAs, it can be really quickly. Oftentimes, if you get an insurance carrier that's not well versed in that can take 2-3 weeks and can really hold the process up. So I would say that insurance carriers that write ESOP companies under D&O and fiduciary regularly see these NDAs and non-reliance letters from all the same valuation firms, for example. So as long as it's an NDA or non-reliance they've seen previously, it can be a quick sign off, and we can get the underwriter's attention on it and turn it around pretty quickly.
And that's my experience is the client has an insurance agent that doesn't understand this stuff, and then they're trying to get their carrier to understand it, and then we're like, oh, look, guys, let's just go ahead and call Patrick. It's like, sometimes that just is the way it is, or we do our best. I've seen it happen, but it's hard sometimes for some people to really get it. It's that nuanced, honestly.
Yeah. Well, I would add to that as well, that we often work with an ESOP companies or to be ESOP companies' current insurance broker. So we will act as what is known as a wholesale broker as well. So we can be accessed by their local broker or national broker, can then bring us the submission, and we can negotiate and place coverage on their behalf as well. Cool. So you can kind of get best of both worlds situation. You can kind of keep the relationship of the broker. You don't have to deal with 2 insurance brokers. Not many people, Phillip, want to deal with 2 insurance brokers or 3 insurance brokers. So we can often work in that capacity as well and help people out.
Yeah, that's actually a really good point. Yeah. So relationships are so important to some companies, and we're just now doing this. So it's like, it may not be, I want to replace everything. So I think that's really helpful for you guys to be able to do it. Is it add more cost to the whole thing for them, or is it less?
No additional cost whatsoever. All it does is maybe just slows down the process in terms of getting the information from one party to another. And if for example, you have professionals involved in the transaction like yourself, are you then liaising with that insurance broker or directly with us? Does it just add a channel, delaying the process a little bit? But we can often just include the local insurance broker after the fact, and work with them in the future on the renewal, for example.
Oh, that's cool. That's good information. Yep. So trend wise, what are we seeing really over the last year, 2 years on premiums because of ESOP world or whatever? What are you guys seeing? Is it going up?
Yeah. So I'll take you back to sort of pre-COVID, those halcyon days. And we were seeing 5% increases at that stage. 2019 into 2020, we started seeing 10-15% increases. And when you can compound that out on a $10,000 premium, suddenly post-COVID, you're at $15,000 on what would have previously been a $10,000 policy. So compound interest can kind of work against you really in that sense. But we're really seeing premiums at a stage now where they are decreasing by 5% or maybe increasing at a maximum of 5%. Most renewals now are flat. in terms of pricing. So there's a lot more capacity in the marketplace. There's a lot more willingness to write ESOPs, from what I've seen in the last sort of 6 months or so. So I believe it bodes well for the industry in general.
Yeah. I think that says something about the industry too, because if that's happening, then there's probably a stabilized, like things are getting done much better with a lot. I mean, volatility in the ESOP world means to me, a deal got done and it blew up, right? So there's a DOL claim, and that means the insurance is being, the trigger's being pulled, and that is going to ripple. So I think that's a very good sign. And honestly, from my perspective, with all the new legislation, with now the Department of Labor having to come in and give more guidance, I'm expecting that to continue to stabilize, maybe even reduce some of the risk in the future. But we'll see. Nothing ever really gets down, but
and I think it's important for brokers to let insurance carriers know about all these good things that are occurring in the ESOP industry and regulation with the DOL and guidance from the DOL. So absolutely. Hopefully that helps the trends in lowering premium, more capacity in the marketplace, and more willingness for people really to create ESOPs as well.
Yeah, exactly. Now, because you're the broker, you're not really involved in this as much, but what's your insight into the claims over the last year? Has it gone up?
So I mentioned to you previously that the employment practices coverage really was seeing an increase in claims on that, just really because it's high frequency. But with the fiduciary coverage, it really is low frequency, high severity. Now, we do often, policies do often get tagged with an investigation, but an investigation might not yield any defense costs, might not yield any settlement or judgment. So we do see still that we're getting notifications on our policies for investigations from the Department of Labor. But really, in the last sort of year to 18 months, we really haven't seen any major claim activity in terms of judgments or settlements on the policy. Now, every now and again, they can come around every couple of years, and you have a real high severity event.
Yeah, something happens, and and it kind of big wave happens, and then it kind of settles down again. So, so going into like when I was kind of I was going to ask this earlier, but I'll just ask it now. So, is there something that makes a company more insurable or less insurable? And I know the answer to that is like somebody's more risky and less risky, but is there a time where you're like, we can't provide coverage for somebody? And what would that entail?
Yeah, so I think the big ticket is the trustee. So if you're doing a transaction without an independent trustee, I think there's a lack of people in the market wanting to provide coverage. We actually saw a couple of insurers pull out of the market for any internally trusteed ongoing ESOPs, and these were ESOPs that had been in existence for 20 years, and the people within them had been a trustee for the vast majority of it, but they suddenly turned their back on writing any ESOP which was internally trusteed. So but what we see now is that more people are looking to have an external trustee. More underwriters are looking for a company to have an external trustee here, and especially at the transactional stage.
Do you guys on the trustee side, do you look at I mean, I don't know how to ask this question, but is there some trustees that you're more comfortable with and there's some that you're less comfortable with? Or is it pretty much, if you're a trustee, we're comfortable with you?
I think the underwriters, one of their best friends is probably Google, in that they do Google companies, and they specifically look for litigation involved and various different things. And I think they maybe have it in the back of their mind is, well, if we extend coverage, what's the likelihood of us being investigated, this company being investigated as part of a trustee being investigated, for example. So I think they may be credential service providers.
Sure. Yeah. And I think part of the process to go through developing an ESOP and brand new from out of the chute, you're going to interview trustees, and that's going to be likely one of the questions you should ask the trustee is like, have you been investigated? Have you had a claim? Have you had any Department of Labor issues? Tell us more about that. And so, before you get too deep with hiring the actual trustee, some people put an ESOP deal together and they just kind of, I don't know. I'm just like, the way I do it is I always interview at least 3 people or 3 trustees just to get a good sense of who's a good fit for us. And I think that's the right thing to do from the fiduciary standpoint, but I know some deals get put together and they don't actually go through that whole process. But, not to say that their trustees are not insurable. It's just, I think it's helpful to ask those questions.
Absolutely. And another thing they really look for is, did you follow any process agreements when the transaction's been done as well? That's a question that gets asked.
Yeah. That's a good question. And then the process agreements, for people's, understanding, is that is what the trustee has to follow or should be following in terms of the actual transaction. And that includes independent valuation firms. That includes the way that they negotiate the adequate consideration for the purchase price. There's a lot involved in that. I think, I don't know if this is true or not, but the process agreements, are they going to be replaced with the Department of Labor's new guidance? And, I've kind of talked that up a little bit. I don't know. For right now, we're still kind of under that. So I don't know in the future if the Department of Labor comes in with something that's going to replace or supplant the process agreement process, but process agreement.
Yeah.
Anyway, so I don't know if you know anything about that, but it's just something I'm wondering how it's going to change.
I think it will help underwrite these things if that is the case. And like you, I don't know if that'll supersede anything or not at this stage. But I think it definitely helps the industry as a whole, and hopefully it's not too prohibitive, whatever guidance they put out there.
Yeah, it'll be interesting because I think I'm shaking my head wondering, will it be better when it's all done? I think if people think it will be, but it's hard for, I think, the Department of Labor to make a strong statement, with anything. It's easier for them to sit back and judge what people have done. It's much harder for them to put something out there. Then it's subject to interpretation, right? Just like the Internal Revenue Service code sections, and how do we interpret that? And some things are going to be hopefully black and white, but we'll see. Hopefully it does make it all better, but sure. So that's great. So anything, as we kind of close out the episode today, anything that you kind of like help people to be prepared for when they're thinking about doing ESOP from an insurance standpoint?
I just really think, like you've mentioned, going through credentialing trustees, maybe I think the important thing is also to speak to your insurance agent and let them know what's going to be coming down the pipe with this, because they're going to need to make adjustments to their policy if there is going to be an ESOP transaction as well. So I think notifying all the parties who are going to be part of the transaction or needed in the transaction is important, and to get a good head start on that, I think that's vital.
Yeah, that's absolutely vital. So with all of that, I think that's very good information, and I love what we covered today, because it's just that's really key to what you're going to be expecting. So Patrick's an expert at it, and if you guys want to get a hold of Patrick, just what your insurance, like, you guys have a website or something, or?
Yeah, we do. Murray Insurance.
Okay.
Assured Partners, Murray Insurance. And we're also on the ESOP Association website as well, in their service providers section.
Awesome. Well, great. Well, thank you so much for helping us out today with the information that you gave us. And for everybody else, we just want to say thank you for listening, and check us out on our website at journeytoanesop.com. If you have more questions, just please shoot those over to us. So with that, have a great day and enjoy your next step on this journey to an ESOP.